Hi everyone, this is Mehul Mehta and welcome back to my YouTube channel. So for today's podcast, we have a very special guest. His name is Mr. Andre. So Andre has decades of years of experience in the quant finance space, close to more than 20 years of experience. So in today's podcast, Andre has certain slides which he'll walk us through. He will basically help us understand the evolution of quant finance, how you can start how can you kickstart your journey in quant finance, and we'll learn a lot of practical stuff from Andre. So first of all, thank you so much, Andre, for joining in today.
Thank you very much for having me. Just a few words about myself. I've been a quant now for nearly 25 years, having been in finance for nearly 30 years. I started in Russia nearly 30 years ago in more traditional investment banking until going to do MBA, hoping to pursue traditional quant career. And it was during that program that I learned about the quant jobs and decided to do a U-turn. And since then, I worked for places like Dresdner Kleinwort, HSBC, Goldman Sachs, Royal Bank of Scotland. Spent 4.5 years on the buy side for a 25 billion family office of Russian billionaires. Before moving for a couple of years to consulting, working for Pricewaterhouse and Deloitte, and then back on the sell side, where I currently lead the structured credit quant analytics at Barclays. So my main asset class has been credit, so I'm back to credit now. So that's my story.
Thanks, Andrew, for sharing your background and sharing your story. And I'm very excited for this because I know like we the all the students and all the people can learn a lot from you. So Andrew, like, can you just if let's say if someone is starting fresh in the field of quant finance and they want to kickstart their journey, how can they do that?
Yeah, well, I think one would rather start from learning about the job a little bit because there are about 10 different identifiable jobs for quants, and people quite rarely know what the jobs are. So let me try to share a few slides with you about it because
Sure,
it's easier. There's too much material to otherwise present.
sure.
One moment.
Also, this is for the audience that please stay tuned till the end because we'll be also talking about how, interest rate models can be calibrated. And these are some practical stuff which you should all know. So just stay tuned till the end. Yeah, sure, Andre. I
Yes.
can see your screen. Yeah.
Can you see the evolution of the profession screen?
Yep, I can see that.
Excellent. So there's a lot of material on the slides, and I'll just try to quickly go through this. Um, Firstly, a few words about jargon. So when we speak about quants, we usually do not speak about all so-called quantitative analysts because there are many more quantitative analysts and people who do various quantity jobs in financial organizations. But typically, quants mean people who use advanced mathematics to solve whatever problems they may have. So traditional quantitative analysis mostly started on the sell side, where people were trying to optimize portfolios, especially portfolios subject to market risk, so asset-like portfolios. And they invented CAPM, factor models. They were using simple statistics and time series analysis. And in this context, actually derivatives pricing started because Black-Scholes, the creators of Black-Scholes formula, were looking for ways to hedge stocks with options. They were not trying to solve options. They were solving the opposite, kind of the inverse problem. And that's how their uh, formula emerged. And it kind of quickly came to the sell side. So on the sell side, people realized that if that formula worked, then you could create derivatives without taking any risk, without theoretically supplying any capital. So we still have this aberration of kind of derivatives pricing on the sell side, although everybody knows that it is just a theoretical approximation. So, and since then, many more jobs emerged on the buy and sell side. So today, on the buy side, you still have more MBA and CFA like crowd who use more traditional methods to optimize portfolios. They are sometimes augmented by machine learning, but machine learning is usually used to improve your expected return forecast. And after that, they still plug it into some variance covariance optimizer. And in the meantime, pure quants emerged on the buy side, who deal with algorithmic trading and quantitative investment and with high frequency trading. So yeah, you now have traditional quantitative analytics, proper quants in the traditional meaning of the word, and some machine learning researchers as well on the buy side. On the sell side, of course, I would say 90, 80 or 90%, maybe 80% of quants are really pricing quants who develop pricing methods for various derivatives. ML gradually moves into that area as well, mostly to interpolate various market data like volatility surfaces, but that is not the mainstream anyway. And they are purely kind of risk-based quants working on the sell side, who mostly interpret the regulatory models and deal with capital. And again, there is, as I mentioned, there is some machine learning, but it's not that big. Now, there is a term strats or strategists that's coming from Goldman Sachs originally, and it usually means the amalgamation of quants and IT. So in Goldman, these people are very professional, and they solve kind of both IT and quant problems. Rather, they just do what at large what IT does in other places. And in major banks, not Goldman, you can hear about strats as well, but that usually means something else. It means quants that work directly with the desk and just develop various desk tools. But you also have fintech and you have consulting. So consultants uh, quite often supply, at least temporarily, quants, mostly to the sell side and mostly to people who deal with risk. So they naturally employ quants. And of course, fintech now not only develops software, but sometimes it runs software. So there are different types of quants that they employ. And while we are on this slide, I'll give you one big hint that if you're looking for a job on the buy or sell side, so in real business, but you fail to get it, you fail to get a job at the front office, and you're offered to go, for example, on the work and risk or model validation, I would strongly suggest to consider consulting instead. I'll
Okay,
explain that maybe a bit later.
sure.
So that's just a bit about history. And this is the kind of migration chart of all jobs that exist in all these four areas. So only on the sell side, only in banks, there are 5 different jobs. So in front office, there are so-called quant analysts, quant developers, and strats. I'll touch on that, on what they do a bit later. Then there are people who work in risk. So these people and people who work in the model validation. But in a nutshell, these are the people who develop pricing models and mostly market pricing models. There's very little opportunity for being original here. Most of this is solved. And these are people who implement regulatory models, which are used to compute capital, which now is very important and has become very important in the past 15 years after financial crisis. And these are the people who validate the quality of both these models and interface the regulators. And on the buy side, you have two types of quants: people who are pricing quants and who still develop pricing libraries, and these are very similar to front office quants in banks, and people who assist PMs in portfolio construction. So this is different. This is where people use stats. They may use machine learning, but again, you should not forget that the main numerical method and main model is linear regression, and there is very something like is masquerading for linear regression. And then on fintech, you have two types of quants. Yeah, more traditional quants, which again are similar to this or this. This actually would be here. It's if the fintech is only writing software and selling software, but most fintechs now try to offer software as a service, means that they not only writing software, but they run it. They have to generate end of day and intraday reports for their clients. And in this case, they need to have people who know how to run the software. So they also require quants, but really more of the quant developers, if you want to speak in terms of front office and sell side. And lastly, you have consulting, which mostly augment this sort of people on the sell side. So, and as I said, so if you didn't get these jobs, especially these jobs, and you don't get these jobs, quite often you'll be offered to work either here, either here. So it's much better to go to consulting instead because you have a chance of doing roughly same job as here or here on the sell side, but be assigned to different bank every third month or every 6 months. So you'll have a much better chance of developing your network and potentially find a job somewhere here if you don't like consulting. Consulting is quite exciting by itself, which I can say kind of from first-hand experience. And one more thing, which is very important, is you have to be honest with yourself about why are you doing this and what's your true motivation. Because there are roughly two types of quants really that exist in the world, and I find it very useful to classify them in terms of their pleasure and the way they optimize that pleasure. So, so one is more like perhaps market-oriented people that want to maximize their pleasure from spending money they make under constraint of doing the quantity job.
Hmm.
And this is not a traditional view of the quants, because more traditional view or expectation from the quants, especially from the market people, is that these are geeks who just enjoy doing math and development and this kind of quasi-scientific job under the constraint of being paid just a little bit more than academia. So the reality is that nobody knows exactly what the split is, and although expectation is that most of quants are from the second type, that they would do just kind of work for food as long as they are allowed to do something interesting, I'd say from real experience and uh, once people go through ranks, it's at least 50-50, if not the other way around. So it is quite important to realize that there's nothing wrong from you using your special skills to just getting richer. And for me personally, I think if a person comes to work in finance, that's what the final motivation should be. So I guess that covers the initial question.
Yeah, definitely. That definitely covers the initial question. So moving on, Henry, I do have certain other questions which I have in mind. So let's say, in your opinion, like which is the most important subject that one should focus on for building a strong foundation in quantitative finance?
Yeah. So I'll use this opportunity, the opportunity of this question to show you a big laundry list of skills. And the answer is not what you expect. It's
Okay.
not math. It's not programming. Well, there is something about math and programming, but the most important skill that you need to develop is learning and problem solving. That these are the important skills. You'll be learning all the time. You'll be learning stuff that you haven't seen before. And quite importantly, what you'll have to learn, people who know me, especially from LinkedIn know that I joke a lot about Ito Lemma and stuff. Once you start in business, this thing on the right is most important, that you'll be reading other people's documentation. You will getting through math, which was done by other people for the past 25 years. You'll be debugging and supporting others people, undocumented code, mostly in C++, but possibly in something else. So that's what your knowledge is really useful for. Your math knowledge, your general STEM knowledge, and your ability to learn. That's what you will need. So, of course, if you go to the previous slide, there are a lot of things that you need to know. You need to know general math. You need to know calculus, stochastic calculus. You have to have this kind of STEM mindset where you want to go kind of from experiments and you should be good working with numbers. But you see, a lot of people have this these days, and you can get it nearly for free. If you have enough time to study, you will get it, and most people have it, especially those going through MFE programs and something like that. Therefore, the real differentiators are here. It's your ability to learn, your happiness to work in a team to solve a lot of problems, and very importantly, your social skills, your IQ versus EQ. That what becomes a true differentiator. Banks these days receive hundreds of CVs of grads and interns, in turns, and those who make it in the first rounds are then differentiated by this, not by this. There's only so much you can learn in the first 3, 4 years in college,
Right.
and you'll have to learn a lot from scratch pretty much when you start. Again, actually, it's a good opportunity. So we all know people talk about this 10,000 hours at work.
Yeah.
So you always need 10,000 hours to, well, I had a slide on this. I just probably forgotten to put into this presentation. But if you do a very simple math, suppose that you work 8 hours per day and you work for 250 days a year, which is a standard number of business days per year. So if you work like that, then for you to accumulate 10,000 hours, you'll need 5 years.
Yeah.
All
That,
right.
yeah.
And when you start in a bank or start in well, mostly on a kind of markets organization, you start as an associate. You will not be given 5 years as an associate. Never happens. You need to really make into MD into about 3.5 years, which implies that you have work longer hours or you'll have to work more days or both. But realistically, if you work about, you can do the math, but realistically, if you work a kind of longer hours and within 5 days or maybe sometimes 6 days, that's what it takes to accumulate 10,000 hours in about 3.5 years. People who work in proper investment banking, like MBAs, that's what's expected on them. They normally start in September, so that's your kind of a third of a year, and then 3 more years after which you either don't make it or you become a VP. That's how it usually works, and it's not much dissimilar for high performing quants. Really, it's roughly same.
Right.
So
Also,
yeah, so this we looked at. I think
yeah.
that would be your next question.
Yeah, that's what actually I wanted to ask, Andrew, so programming languages, so many programming languages, C++, Python, MATLAB, SAS, RStudio, and whatnot, right? And people are so confused, exactly. There are so many more languages. And then, what do you think? How should someone start? What does the industry require? Because
Yeah,
lot of confusion on that area. So if you can help us understand that.
you forgotten the most important one. About 40% of core banking is still run on COBOL.
Okay.
You know what it is, yeah? So core banking, meaning your overnight payments. You
Mm.
may notice that if you make, for example, a credit card payment, that it takes one day for that to run. If you move kind of repay your credit card, that's because those payments are handled by these old mainframes which still run COBOL. So I'm a bit joking. It won't be required, but if you're a COBOL specialist, especially in particular after COVID, there's been a huge demand for them, and they paid really good money, and it will stay here for a very long time, maybe for another 50 years. But being a bit more realistic about what is really required, all right. So if you want to be kind of a traditional valuation quant, which is a fairly stable and important profession, because these are the people who mostly support but also extend models to price derivatives and price positions in general, you need to know C++. There is no way around it, and you need to know modern C++. So you need to know such things immediately as RAI, as type erasure, as variant visit pattern, and all this. So I'll briefly go through that I think in a second. But you need to know at least C++11, ideally C++17, and however, it does mean that you'll be writing in all those languages because many libraries are still using C++98, so quite old one. So you need to know kind of both of them and be fluent in both of them to be a professional quant or quant dev. Now, another thing which is kind of useful and in particular useful if you work in high frequency trading or electronic trading is Java. Everything which is based on Java, virtual machine, and to a certain extent .NET, but .NET sadly is not making kind of an impact there. It is still Java. So on this slide, I would say actually left and right are most important. And if you know one, well, if you know C++, you can go anywhere else, you can learn anything else. Java is good, but mostly electronic trading. Now, SQL, quants normally don't work with data. All
Mm.
right? Because, well, the only market data you use is usually today market data or maybe some histories of your price, some path dependent options. But SQL is still is so cool to know it very well. People don't realize that it's like C essentially in its capabilities. It has loops, it has variables. Only in addition to C, instead of structs, you can have table types. But if you think about table types as structs, it's very similar to C. Well, you don't have mallocs. You don't have to work with memory. But otherwise, it's very, very powerful, very useful language to know. There are only a few people who can know SQL, who know SQL very well beyond just writing some queries.
Right.
Now, Python and R. R is a niche language, so it's not really used anywhere in prod, or maybe some hedge funds use it, but as some hedge funds use MATLAB as well in prod. But this is really niche. So it's good to know, but it's practically not much relevant. Python. Everybody is kind of learning Python now, but there's one thing to understand about Python. Um, for pricing quants, having only Python on the CV is bad. It's
Mm.
actually not good, it's bad. I'll tell you in a second why it is bad, because it usually means that the person has never worked in a proper software development environment. Because hacking something for yourself, even if you use Git to sometimes kind of save your code, or just hack something at university, is very different mentally from working in the quant environment. And the most important thing is that the ownership of code is shared. This code is not yours. And there are two main aspects of that. First, you have to know how the process works, and you have to mentally be prepared to let go. Many other people have to agree that what you're doing is correct. Your code will be reviewed, your code will be rejected, and once you grow through the ranks, people will most definitely do stuff in a way that you don't expect. So at some point you have to let go, but at the same time, you have to be responsible for that. So it's very different. The kind of developing code in a quant environment is very different from just doing it for yourself. It's a totally different production grade process. So to sum it up, and there are a lot of other tools here at the bottom which are kind of useful. You need to have some idea of build systems, some scripting kind of operating systems scripting stuff, some more exotic languages. Well, there are some people who implement whole libraries in Haskell. Maybe there are banks who do it, but that's really really exotic. Or F sharp or Camel. Go from time to time comes in. Everybody talks about Rust, and of
Right.
course. Again, having pure Rust on CV is equally as bad as having Python. Why? Because it basically shows that you want to become, it's probably more important for programmers than quants. I mean, quants don't use Rust. But if you invested time in learning Rust, but you haven't invested time in learning C++, implies that you hope to avoid more difficult and demanding jobs in supporting existing systems.
Right.
And that's what people do a lot. So you're kind of trying to show, I want to work on a cool new stuff, but I don't want to be part of the team. And that's what it really means for Rust and for Python. So bear that in mind. You do want to have, it's fine to have either on a CV, but you do want to have C++ in that case, meaning that you're happy to kind of get your hands dirty and not just do kind of nice and cool stuff.
Yeah, but like I'm just curious because you mentioned about Python and you did say that, oh, I mean, I'm just curious and want to understand your views. Python is like everyone uses Python, right? All quants uses Python.
No, depends for what. I mean, they used for hacking. So Python is a substitute for VBA. That's a way to think about Python. So 15 years ago, everybody used Excel and VBA for this kind of analysis. Now data became large, and people are trying to make alpha and make some better tools using Python, but in reality, it took place of VBA. It's not taking place of C++.
Yeah, so but at least if let's say, because we do deal with a lot of data, cons in general, they deal with a lot of data, and you have high frequency data, so many data types, right? So, and I don't think so. Do you think like C++ will do a better job in analyzing the data rather than Python, or is it Python that wins?
Where it's different, as I said, there are different types of jobs. So there are people who support trading systems and pricing, and that will be done in C++. It is still done in C++. It will be done in C++. It can do pretty much anything that Python we can do now, only faster, and it's easier to support because it is statically typed language. So for anyone who tried to support a system in Python will know how much more difficult that is because it just breaks unexpectedly. So to just analyze data to come up with prototypes, yeah, that's fine. But that's exactly what VBA or MATLAB has been used 20 years ago. It's nothing new. But in a production setting, you don't
That
want to
everything.
have Python at all. You'd rather have .NET because C Sharp these days, if you want to compare Python to something, it's probably closer to C Sharp. They go like it's almost like chicken and egg situation who invents first, and they are nearly equivalent. Now, even in the C Sharp, you can write it without all these main static methods and classes. You can write from starting from C Sharp 8. You can write code as you do in Python without enclosing functions and classes. So, but the difference is that okay, Python is not supported by anyone except for some volunteers, or maybe there are a couple of third-party companies, while .NET and C Sharp is supported by Microsoft. So there are a few big projects outside, like big compute projects, which are implemented in Python, and people try to support it, but it's difficult.
Hmm.
So C++ will be there for sure, especially C++ 20 and coming, C++ 23. And it's kind of, if you don't want to go deep in it and know all the inside out of the language, you don't need to do it. You can do almost kind of Python-like development on it. It's now possible because you have autos and you have so-called type erasure, you have variants, you have any's and all that. So you can do it all in C++. But of course, since you have a lot of libraries to play with data, yeah, you'll be using Python for that. But as I said, 80% of quant jobs don't do that. 80% of quant jobs support pricing and valuing of products, and that is done in C++ and like parallel C++, very modern C++.
Okay, okay, because I had a different take on it, honestly. So you are saying like 80% of the jobs they take C++, and in my view, because I don't so I only see few quant developer jobs, but most of the jobs that you will see are in quant analyst or is in risk domain, market risk quant or credit risk quant. So if you see quant developers who are putting everything into production, they are the one who are writing like the C++ codes. But let's say someone, because I know so many friends of mine, they are doing everything in Python, and not just friends. There are so many people who are quant analysts, and everything they do in Python, they write the whole scripts. And then, once the models are made, let's say pricing model and everything is made, then that is transferred to the quant developer team who optimize the code. But but building on the codes, or let's say what to build, I feel like more of a quant researcher and quant analyst job. And what I know, because I know I have spoken to a couple of hedge funds, and they, even the founders, said that for quant researcher and quant analyst team, where the most of the quants are employed in their organization, that's where, I mean, they mostly use Python. But again, I can be wrong, but that's what I have heard.
No, it's not about being wrong. It depends on what people you talk to and on what side. I mostly talk about people on the sell side in banks,
Hmm.
and on the buy side, the business model is slightly different because on the sell side, the key um, the key skill is ability to price a product and to be very accurate and to be very fast in pricing product because even the buy side very often relies on the sell side to provide prices. So there it is, as I said, it is 80/20 C++. All those methods are implemented in C++. On the buy side, there are only a few funds who implement their own quant libraries. There are few, and I promise you that those who do implement them, they will be doing that in C++ for sure. The best example is that Citadel just hired Herb Sutter. Who is Herb Sutter? Herb Sutter is the main guy who took from Strauss in designing C++ in the past 20 years. He designed C++ CLI, which is the .NET version of C++. And he is a guy to a certain extent behind C Sharp, but not that much. He's a pure C++ guy. So the top hedge fund hires the top C++ person. So that tells you something, right? The Citadel, right? So they do use C++, although Citadel is probably one of the better run firms. If you speak about funds who do not engage in pricing and who only do pricing strategies, yeah, for that, they will be using Python.
Okay.
And they may even use it in prod. And again, they're very famous, very large hedge funds that have been using, well, at least one that I'm aware of that is using MATLAB in production, which is not even Python. But you have to realize that the jobs that people do in those two areas are very different and they're paid differently.
Right.
So in a hedge fund, if you work in a hedge fund, you really need to be a PM to be paid.
Mm-hmm.
Unless you're a PM, really, you will be paid maybe somewhat similar to the quants on the sell side, but your Sharpe ratio will be much worse. So volatility of your pay will be much higher. So if you want to kind of have a well-paid quant job and with reasonably good Sharpe ratio, you actually want to work on the sell side, and
Mm-hmm.
for that you'll need C++. plus plus.
Okay. Okay. Perfect. Also, like, I'm just curious, like, what do you think is a day in a life for Quant? Because you have been working for so many years,
Yeah,
right? So, like, how would you recommend? How would you suggest, like, or
yeah.
like, how does the day start in the life of a Quant?
Yeah, there was one more slide which I didn't have time to talk about, but this is something that, again, people who work in, well, I mentioned it briefly, but if you prepare yourself to work in production
Yep.
environment, you need to get familiar with version control systems and how this all works. I kind of talked through that. So educate yourself about version control and be prepared that once you get the code, you modify it, you'll have to test it, it will be peer reviewed, it'll go through regression test on continuous integration, and then you will submit. It is kind of a lengthy process. And we kind of talked about programming, but again, language actually is not that important, but programming is important.
Right.
So you need to know algos, you need to know data structures, and you need to know that, there are two parts in the libraries usually, which changes quickly, which changes slowly, and they are modified, by slightly different people, as Mehul just mentioned. So, uh, and usually, like the most pro quants actually deal with the slowly changing code, and they make sure that it is maintained, that it is robust, and from time to time they have to incorporate some kind of new ideas. But programming this stuff, so sorting, searching, iterating product space, Bellman equation, which is like price numeric options, or some sort of any sort of optimization, to time optimization, recursion versus iteration, this kind of stuff that you need to learn, and that's applicable to any language. So speaking about the quant jobs, now to your question,
Mm-hmm.
so as I said, on the sell side in particular, there are three areas where quant exists. Quant exists in the front office, quant exists in risk, and there are quants in model validation. So these are the people on the front office who really develop kind of pricing models.
Mm-hmm.
And in most cases, like 80%, they actually implement and support already implemented market standard models. They all know, but you'll be surprised that depending on the asset class, banks may or may not even have implemented models that have been around for many years. So the risk quants, they deal with implementation of regulatory models. And again, sometimes they have to implement their own pricers, but in addition to that, they have to implement various kind of scenarios, risk scenarios mostly, even modern market risk, which is called FRTBSA. It is still a kind of variance covariance VAR-like scenario. And then there is a central team. So both these teams sometimes do implementation. This team definitely does implementation. So in the past, like 20 years ago, on the sell side, the setup was pretty much as Mel just described. There were like pure quants who were developing math and prototyping, and then there were quant devs who were implementing that. That is gone. There's still quants and quant devs, but they mean something different. I'll explain it in the next slide. In risk QA, The models are mostly developed. They are provided by the regulator, and you have to only implement them. So yeah, there is a setup where quants, risk quants, only interpret and understand those docs, and they give it back to IT to implement. Not even quant devs. There are no quant devs in this area. But in big banks where quant libraries contain both pricing and risk code, these quants may implement these methodologies directly in the quant library. So those implement and those kind of mostly implement too. Then there is a team, which is also quantity team, which is called model validation, and those people don't implement anything, but they agree with both front office and risk quants the amount of tests they have to apply to their models, and then to produce the model documentation that they then validate and present to the regulator. And based on that, regulator will allow to use certain models which may result in saving of capital. And that's very important. So that's actually, these are the three specializations of quants on the sell side. And a bit more about specifically the front office quants, as I said, there are four types and three types. There is this fourth type that Mehul just mentioned. So quant analysts really design, research, and develop pricing models, trade objects, market data objects, calibration components, risk reports, and all that. These are the quant analysts. The complete opposite of that are called strategists sometimes, or the kind of desk quants. These are the people who develop the front office tools, mostly based on Python or on Excel, C Sharp, and that kind of stuff, sometimes maybe on R. But these are the tools that are easily used by traders to mark market data, to perform pre-deal analysis and stuff like this. So, and then in the middle, there are quant developers, which now mean two things. They either support very low level of the library, so real numerical methods and some other primitives. And the people, these are more traditional to Mehul, those quant devs that you referred to in the beginning. These are people who actually configure the quant libraries and help IT run end-of-day batches. So one thing is, for example, to say, okay, this is my model to price options, or this is my model to price interest rate swaps. So these people will decide. So these people will maintain vectorized version of the exponential. So if you have a vectorized pricer, then there'll be some vectorized version. Vectorized meaning that you'll run on GPU, or that you can run in parallel on CPUs that support it. And these people will say, okay, for like if we speak about LIBOR times, for example, they were conventions. They're still conventions, but here it's the best example. So fixed or floating swaps had different conventions for different currencies. Like in dollar, it was 3 months floating versus 6 months fixed. In euro, it was 6 months floating versus a year fixed, and in pounds, it was 6 versus 6. So to configure these models to be run in production, those people knew the conventions, and they worked with IT to actually set up all these models to be run. And finally, yeah, you had quant researchers, which kind of overlapped historically with quants, who did a bit of research, and people still do research, but mostly on the buy side, where they invent trading strategies. QAs do very little research because over the past 25 years, nearly all research has been done.
Okay. Okay.
And just a couple of more things, it's useful for your audience. So there are like three types of activities that front office do. Something which is called strategic development, tactical development, and what we can call legal stuff. This is the easiest one. This is like documentation and testing. Strategic development is like big library projects which may span years, and tactical is usually an incremental change to some pricers, some features, some reports. And it's very important that if somebody is offered a job in the front office and they ask to join a strategic development project, it's very important not to join the project unless it is of existential importance for the organization, like implementing something because it was required by the regulator. It's very bad to join a project which is just driven by some internal people. Like if you hear something like rewriting C++ library on Rust, don't join it. It will probably fail within 3 years. Everybody will be fired, and you'll just waste your time. It's very important because why people who are in the business know not to deal with this stuff. They try to go to the technical. So just be aware of this. And well, This, I guess, the direct answer to your big question of what people of different specializations do in these different jobs. So basically, what we have on the x-axis, we have modeling, pricer implementation, writing documentation, front office tools implementation, testing. This is development testing. Then you have deployment, dealing with IT, configuration, development, business as usual support. And then you have dealing with clients, so model validation, uh, dealing with the business, and then you have study, and you can see that only quants. So quants are green, quant devs are blue, and strats are yellow. You can see that only quants, and only a little bit, have time to study theory, to read mathematical articles or something like that. Nobody else does it. Nobody has any time for this, and most of math has been done already. It's only some technical projects that require reimplementation something. Everybody, however, has to learn a bit modern IT. So that is here. But again, together, that's 5% of time. And you can see that the green ones, the quants, they mostly spend time on implementation. They spend a lot of time on testing, and they have to deal with model validation. Yeah, that's their main activities. While quant dev, they configure and deploy the models, and they deal with IT on actually doing the stuff, and they still residually implement pricings. And of course, the strats, they develop the front office tools, they still test, and they deal with business. So these are three different jobs. I have more slides on really what the requirements for these jobs are. As you can imagine, quants will require more C++, while strats may require Python or C# or Excel or R or something like that. But again, there is much more material that we can cover in this podcast.
Sure. So,
Next.
yeah. So, Andrew, like, to be honest, I just wanted to understand, more on certain projects, like stochastic interest rate models, right? We have so many interest rate models. The evolution started with Vesicek, then CIR came, Holy model, Hull by one factor, Hull by two factor. You have some three-factor models, right? So I'm just curious, have you ever worked on it? And like, what are different ways can, or let's say, what are some ways that such models are calibrated?
Yeah. So essentially, there are three classes of rates models.
Hmm.
There are the short rate or the forward rate models. And
Right.
what you mentioned, starting with Vasicek and then Hull and White and all that. But the common denominator is that what you model is something which is called short rate, which is an abstract mathematical concept, and it does not exist in real life. But it starts with a differential equation like that. It's a very general form. And the key feature of all these models is that to price a zero bond, you have to take expectation. So depending on what dynamics is, you may or may not take this expectation analytically. So for example, for kind of Gaussian models, you can take it, or for affine models, you can take it, like Hull and White or Vasicek would be examples of such models. But for, say, black kerosene scale, for log normal models, you can't do it. And that's a big difference because that affects kind of usefulness of your model in general.
Hmm.
Now, all that is generalized in so-called HGM framework or shared framework. The big difference of those models to these models is that these models model the forward rate directly. So there's no concept of short rate. They take essentially full discount curve as it observed today, and they evolve it into the future. So Vasicek model was one of the first models. Sorry, not Vasicek. Hull and White is essentially a Vasicek that allows you to fully reproduce the initial curve, and that's very important because Vasicek cannot do it, and that's why it's at most used at the job interviews. Or it is used in some other risk settings in so-called historical LMM, but apart from that, it is not really used anywhere because it cannot reproduce the initial discount curve or equivalent to the initial forward curve. It's one is a logarithm of another, really. So that's why AGM is really where you start today. You don't do Hull and White, you do Hull and White in AGM form. And in AGM, you start with so you see here discount factor is not a stochastic expectation. It is just a deterministic integral of the forward rate. And that's a big difference
Right.
because this is just given. Once you have this shape, you can possibly integrate it, whatever your interpolation is. Well, here you may or may not. And once you start with this specification and you have initial curve, this is your equivalent stochastic differential equation. So you only need to specify volatilities. So if you want to have some drifts, mean reversion, well, drift will be specified through kind of combination of the forward curve and the mean reversion speed that may emerge here. And for your model to have so-called Markov property, there is a restriction on the form of the volatility, and it is normally the product of the two. So if you can specify your volatility as a product of the two, then you have you may get some generalized form of the Holland-White model, and usually this. So dependency on the short t, so on this time, this is like local volatility. So you can then calibrate this model to say both caps and swaptions, but this function will essentially capture volatility or instantaneous volatility, and this one is not actually, well, kind of at the future volatility, and this will capture mean reversion. So that's the difference between the two.
Okay.
And that's how it is really done. So then there are different algorithms how, depending on the specification, will calibrate your product.
Okay. So like, can you also tell more on like,
Sorry, one more, because it's one class. Of course, you have market models, which are models like LMM. So
yeah.
the difference between those two models is that in LMM, you try to explicitly model forward rates. So you can see that your whole curve, this whole curve, can be represented as just whatever. It's kind of can be glued out of forward rates. And so instead of modeling this interpolator of yours, which is already, sorry, which is already better than modeling short rate, you can say, okay, I can model each forward directly as if it was an equity. And this is an LMM model. It came up just a few years after the Markov HGM, and this is used as market standard for exotic interest rate derivatives. And it's much more difficult to calibrate. It's quite heavy on its own, and therefore people, if they can, they stay with something like this. And you can still introduce stochastic volatility here. You can introduce stochastic volatility here, but the main requirement for models is that they produce stable deltas. The
Mhm.
best model is like a forward cash and carry arbitrage where delta does not change. Because here deltas will change, but traders would prefer that they do not jump unexpectedly. And therefore, they would prefer a simpler model, which perhaps is not ideal, but they would rather have a simpler model and have some so-called model reserve, which is cash they have to deposit that will kind of offset possible losses for not having a perfect model, but they would rather have a simpler model or simplest model possible than some very complex model which they don't understand or where hedges can change in a kind of in a difficult to predict fashion. So if you have simple options that you want to price, or if you do XVA, you really depart from HGM or HGM Shiat. So which can be stochastic. Shiat had a local, it's a Shiat is essentially local volatility version of this model, and you can make it stochastic. You make stochastic volatility version of that as well. But for calibration and for internal representation of the implied volatility surfaces, it is LMM that is used. And there is one more, something called Markov functional models, which became quite popular maybe about 20 years ago, but they are more kind of niche things, and they're still used by various places, but not that much. They are kind of more generalization of the short rate models where you try to you have some background process and then you have certain mapping functions from that background process to the short rate and or to discount factor roughly. So the thing is that here to capture the shapes of the curve, you typically need 3, 4 factors, and you have to use some non-trivial parameterization of volatility to capture hump because you normally have hump in the implied volatility.
Right.
So this it can be captured here directly because you have so many factors here. Like you
Mhm.
may have like 10, well, 5, 10 factors easily. You'll have to do PCA. So here it was an attempt to kind of improve on that, but it's not that widely used. So these are your short rate models, and not only short rate models.
Okay, okay, understood. And I'm just curious, because we started with short rate like basic XAIR, and we have much more advanced model like as you say like the HGM framework, right? So like which model do you know like which model is used in which setting, or like what are the best ways someone can um basically point I'm trying to understand is can you like share your views or your experience of which model or let's say which was the model that everyone should actually focus on from an industry perspective.
So from industry perspective, definitely professional interest rate quants, they focus on LMM because the various kind of so-called shifted LMM, because this is the model that is used to represent the volatility cubes
Mhm.
internally. So they'll use so-called SABR model, which is a version of stochastic volatility model applied to rates. SABR was not initially designed for rates, but well, it is a general thing. So, but they would use Saber to represent internally the volatility, the implied volatility surface. So you need to know that, and you need to know Saber in real life applications, unless you have real exotics that have to have many factors who really play on the whole shape of the curve. If if your model is such that it is exposed only to a single kind of swap, or you can or to a strip of swaps or caps which do not require modeling of the skew, you just will stay with HGM. Like even if you want to price a Bermudan, for example, you will just calibrate it to a particular moneyness of the volatility surface, and you'll use a simpler model than this full-blown HGM, because this can be semi-analytical sometimes. This is very heavy if you were to do Monte Carlo.
Right, okay,
So in all cases, you calibrate. You never do kind of historical calibration. You never do that. You may use historical time series only to estimate correlations in a high dimensional model, this or this. And here it would be easy because you model forwards, so you'll know time series from which you will have to derive correlations. Here it is much more difficult because you'll have to extract factors, and then you'll have to construct time series of factors, and determine correlations of those. So this is more difficult.
okay,
But in all cases, you calibrate to implied. You never calibrate to some historical time series of rates to determine volatilities, neither here nor there. You always calibrate to volatility either surfaces or cubes.
okay. So you mentioned on the calibration piece like so like how can because we have so many instruments out there, right? So which instrument should or which instruments are used for calibration?
Well, you have at least swaptions and caps and swaptions,
Mm-hmm.
which will allow you to calibrate both of these models. But
Mm-hmm.
at sometimes, well, depending on your problem, you may calibrate to Bermudans as well. So you normally, it depends on the problem, because calibration will be used in a second to compute hedges. So you want to calibrate to the model, to the products with which you're going to hedge. That's the general idea.
Okay, so basically calibration, like swap options and like caps are like the common choices, right?
Yeah.
Okay,
Because
okay.
you will hedge with these products. That's the idea. Yeah, can
Okay.
I just leave you for 30 seconds?
Yeah,
Just
sure.
30 seconds, please.
Yeah. So Andre, like, I'm just curious, do you have any other material to show off for the stochastic interest rate model? Because I know, like, before the podcast, we also talk about stochastic volatility.
Yeah.
So,
So again, stochastic volatility, um, it's kind of, well, Cyber is a stochastic volatility model.
Mhm,
Um, but kind of conceptually, for rates, it is more important to have high dimensions
mhm,
than stock wall for real modeling beyond representing of the implied volatility surfaces. But the thing about volatility, but in other asset classes and equities, for example, equities and FX, Of course, we have skews everywhere, and it started with modeling the terminal volatility. So all models like Black-Scholes and simple extensions, they're all about modeling total variance or terminal volatility. And then, of course, things like original stochastic volatility models emerged to model skew to certain extent, like Heston. But of course, Heston does not have enough degrees of freedom to calibrate volatility skew. And again, there are like two things in model volatility. First, you have the skew, and second, the skew itself is a random variable and it can be shown that it is it is a random variable. Therefore, once Dupere came out with local volatility, kind of Dupere skew modeling was solved. So there's no problem of calibrating to a kind of terminal skew. You don't even need Dupere. There is some other result. Always forget how to. There is a name for this, but that was before Dupere. And then Dupere allows kind of reading the implied volatility directly from the market, and then potentially plugging it into the Black-Scholes equation, and thereby modeling volatility in the future, both underlying volatility. But this model did not provide adequate dynamics because there is no degree of freedom that would capture stochasticity of volatility, and therefore this is a very famous chart of sorry VIX versus SPX. So it is obviously stochastic and negatively correlated. That's why you have a simple Heston model to deal with that, but the real model that everybody's using is Sabre, which I just mentioned when we were talking about rates models. And what is really used, what's really interesting is a combination of the two, which is so-called local stochastic volatility, which allows you to fully calibrate to the volatility surface, but also evolve it into the future.
Right.
So this is actually a more important thing. But as I mentioned, traders would rather prefer having a local volatility model that we just mentioned in the previous slide,
Mm-hmm.
unless you have a product that is explicitly dependent on stochastic volatility, something like a cliquet, for example, a forward starting option. So when essentially you have an option, you pay for it today, but you strike it sometimes in the future. So in this case, obviously, you have to evolve both underlying and volatility, because the kind of future value of the option when you strike will depend on both. Or another example would be XVA. XVA actually is not using Stockwell models that much, but you can immediately see that XVA increases dimensionality of randomness in your model by one. So if you had interest rate swap, then to price interest rate swap, you don't need a volatility model. You can just price it off the curves. But if you want to compute XVA on an interest rate swap, you have to essentially price a strip of swaptions. So you need suddenly a stochastic model. Same thing, if you have an option, then you could have a Black-Scholes to price just an option. But to price CVA on an option, you need a stochastic volatility model. So that's where it kind of becomes more relevant.
Okay. I do have this question. Like there are different pricing models, right? We have, we started with Black-Scholes, then we came to Hessian, we have binomial tree, trinomial tree, Monte Carlo, least square Monte Carlo methods, right? So do you can you like guide like what all, different models are being used?
So we need to think in terms of a triplet.
Mm-hmm.
A particular model is a combination of the three things. It's a
Mm-hmm.
payoff, dynamics, and numerical method.
Mm-hmm.
So when we talk about analytical versus tree versus Monte Carlo versus PDE, and tree and PDE is nearly same, and they're further in reality combined with Monte Carlos. So in general, we're both forward and least squared. So you really have analytical versus kind of grid-based methods.
Okay. Okay.
Yeah, there's a difference PDE between PDE and tree is that tree kind of grows, the lattice grows and then it becomes constant. In PDE, it is always constant. And in Monte Carlo, it is kind of somewhat, it's not necessarily constant, but it is predictable in time. And it's not predictable in terms of the kind of the value of the variable, but it is still in terms of time, they're always grids. They're always grids.
Okay.
So then depending on what problem you're solving, usually if you can do analytical, you'll do analytical. If your problem is low dimensional, that is under three, dimension under three, then you will try to do a tree or a more generalized lattice, because not all lattices are trees. Or you can do a PDE. That's pretty much it if you have low dimensional problem. And if you have a high dimensional model, like for example, you want to do an LMM, or you have some large cross-currency interest rate model, even with kind of short rates, you may have like two-factor short rates or two-factor HGM for two currencies plus effects with, say, local stochastic volatility. So you end up already with six factors. And if you want to price some hybrids on such six-factor models, you could, in principle, do a PDE, and some very famous quants in not so famous banks were successful in doing that. But
Okay.
they're like PDE specialists and are like doing PDs. But in reality, if the total dimension is above three, you normally resort to Monte Carlo, either direct or American Monte Carlo.
Okay.
So and yeah, it also depends to a certain extent on the payoff, but it's mostly about dynamics, whether the payoff which drives your numerical method.
Okay. Okay. Also one last question, because I know you are working actively in helping out students, teaching them about quant finance, and you do run QA profession. So can you tell us, like, what do you do there? What kind of course do you teach, and like how can students get benefited out of that?
Well, if they benefit from this podcast, and again, I'd like to thank Mehul you for inviting me here, they'll definitely benefit from the course because what you saw here today are slides from the course.
Okay. Okay.
So in the kind of half of the slide, we saw only about maybe 15 slides. The whole course is about 400 slides, and it runs for 16 hours. So it's equivalent to a like a trimester course in the British university. But this is the quality of presentation and the details that you get there. And many of the subjects which we only touched here today are discussed in much greater detail. So I had a couple of more slides here, but maybe I just skim through them.
Right.
This is important in terms of calibration because we spoke quickly about calibration, and essentially you have two models to which you calibrate. You have so-called delta one products, which are like underlyings, swaps, forwards, total returns. So basically something that does not require volatility but require curves to price. And then you have vanilla listed options, which essentially trade the volatility surface. And for those two, you don't need a model to price them because prices are read from the market.
Mm,
But you do need a model to risk them.
right.
Okay, so these are kind of entirely market driven. Then you have exotics, and it is for to price exotics that you need to calibrate your dynamic model, and this will give you the drift one
Okay.
way or another. This will give you the drift, and this will give you the volatility.
Mhm.
And your choice of the union of products from these two will determine your hedging strategy because you'll have to hedge kind of your expectation, you'll have to hedge your variance. So that's what really happens in exotic pricing. But what's important, while prices of these two types of products are read from the market, uh, exotic price can only be approximated
Mm,
because with high probability, even if you calibrate your model, so you calibrate your HGM or you calibrate your Sabre or calibrated your LMM, the price that the model will give you will, with highest probability, not be the price at which you will trade.
right. Right.
And this is because, and this was my previous slide. In theory, once we say that derivatives are just portfolios of some, replicating products, the concept of a derivative is redundant. And
Mm,
that, if you remember at the beginning, you were talking about the whole thing coming from asset management. So what they proved that in a complete, not Black-Scholes, but Harrison, Krebs, and Harrison Pliska, few
mhm.
like 6, 7 years after Black-Scholes, that if you have complete and arbitrage-free market, then any derivative is replicated by potentially very quickly changing portfolio of existing tradables.
Hmm.
So really pricing derivatives, managing risk on derivatives should be nothing more than very active portfolio management, which at the time was quite a revolutionary idea because, I mean, I understand you more on the buy side. People don't like active portfolio management. There's been a big debate on how active portfolio management should be. And if you look at the most successful portfolio investors, both can be quite successful. And we're talking about Renaissance and Berkshire. So
Right.
Jim Simmons is as active as it gets, while Buffett is as passive as it gets. So both kind of ideologies work. But the most important thing is that so derivatives in general are just very quickly managed portfolios. That was the idea. And furthermore, there should be no secondary market for derivatives. That's the second thing. Because if there is a second market, then you have a skew immediately. Why do you have the skew? You have it because market is driven by supply demand.
Hmm.
That's it. So
Right.
perfect derivative is redundant and should not exist at all, and it should be perfectly liquid on the market. And once we have real life, we have XVA, so we realize that real derivatives have counterparty risk in them because a real derivative is always written to you by someone, so unless you want to replicate it yourself, you go to a bank or to hedge fund, not normally to a bank, and say, create this derivative for me. And it becomes a liability. And it may or may not be collateralized. So that's the whole thing of counterparty risk. And you can say that counterparty risk is the cost of identity. That it's not, if it's not a theoretical portfolio, but it's a real liability, it will have counterparty risk. And once it gets secondary market, the value immediately is shifted from the theoretical price. And there are big names in the quant analytics now who try to derive some theories of how you should price those exotics, given that the exotics are never traded in the market at the real value. And so this is landing page of my course.
Right.
Everybody is invited. You'll get much more material, and again, you probably got a good idea of what sort of stuff we're talking about there because normally you don't talk about it anywhere. And this is the first sort of resource where you get an idea of what really it takes to work mostly on the sell side, but also on the buy side and in fintech and in consulting.
Right.
So welcome. And thank you again, Mehul, for organizing it. It was a great fun.
Yeah, thanks, Andy. Thank you for sharing your, years of experience because a lot of expertise you have, and definitely, I could saw from the slides that when you were speaking, and there's so much wealth of knowledge that one can grasp in the total podcast, and I'm very sure like the course that you offer will be great. So thank you so much for joining in, Andy, and thank you for sharing the wealth of the knowledge that you have to all the
Thank
audience.
you, Mehul. Just one thing to say. This is just the way the course is structured. It's a collection of pre-recorded lectures. So similar to sort of podcast. So it's very easy to take. You just get them and you study at your own time. You don't need to attend some lectures or whatever. It's very easy to consume. So
Well,
thank you very much again. And I hope we may do something like that again on other subjects.
sure. Thank you so much, Andy. Thank you.
Thank you.